Hey there traders, my name is Martin. I'm a forex trader working with PFSoft. Today I would like to show you a short presentation about supply and demand zones, how I draw them, what are problems about supply and demand zones regarding most basic theories. And I know that there are many doubts about drawing supply and demand zones, and people traders have lots of questions about it. I would try to present it briefly and cover some most problematic issues about these zones and how I try to solve these problems. So let's begin. Uh, the most basic theory about drawing supply and demand zones says that we need to find pack of candles like consolidation or sideways move. Then we need to mark it with square, let's say. Here we have such situation where prices stays in balance, supply and demand is exchanging orders, price is going up and down, but with no certain direction. It's going sideways. And here it's what such situation tells us. It tells us that supply and demand is pretty balanced, so neither side is winning. And what comes next? Eventually, after some time, price is picking a direction, market is picking direction. It's information for us that one side have lost and another side has won this struggle, and here demand exceeded supply. That's why price moved up, and eventually it moved up quite a nice 250 pips almost. So pretty good demand here, and we assume that more demand is lined up somewhere in this area. If price will go down here, we assume that these buy orders, buy limits will drive price up one more time, right? So there are different methods of drawing supply demand areas. Some of these methods are treating the whole range of our consolidation, of underlying range, as a source of supply demand, as a supply demand zone. So it seems most legit to me. As you can see, this approach to the whole range from top to the bottom is confirmed here, where price found support after it broke up. And on the other hand, we have bottom of our range. Here it's demand zone, and such zone would be, of course, pretty wide. It's like 90 pips. Here we have a bit narrower zone. It's a pretty common approach to draw zone by most traded level. We could mark it like that, and the other extreme level. So for demand zone it will be bottom line, for supply zone it will be top line, and some traders may draw even smaller zone take the most most recent zone from the bottom in this case, because we have here demand zone. So in these scenarios, what's the difference? The difference is, on the one hand, stop loss size, because if we would like to trade by limit, to place by limit orders, we would need to accept pretty big stop loss of around 90 pips. Okay, so for our one lot position, one lot order, it would be like $825 US dollars. So here we have pretty big risk. Okay, 90 pips. It's not everyone like it. If we place order a bit lower, our stop loss would go down to 62 pips, so it's like 30% less. Okay, it's good. But what's the case here? We have lower probability of executing our trade. So price may come down, hit the level of 1,0794, and it would activate this higher order. But if it bounces here, we won't have a chance to trade the lower one with a lower risk, but lower probability of execution. Okay. So basically, we have here something called Rayleigh base Rayleigh. What about this? What about these types of zones? Whether it's better to build bigger zone or smaller zone? Actually, from my experience and from what I know, it's better to draw these zones by range, because traders, for example, in institutions, are trading swings rather than candles or most traded levels, whatever that means. They tend to trade ranges and line charts, so you could possibly take the highest open close point, but ranges, for me, it's most suitable actually. So here we have Rayleigh base Rayleigh. It's a formation when we got pause between Rayleighs, and we assume that plenty of demand here for continuation is placed here. We have also some small range here. Okay, take a look. Oh. So the structure of this breakout is also Rayleigh base Rayleigh. Okay, and we can have it both ways. We can have it downward, so it would be drop base drop. Okay, and in such case, we look for supply zone here. So we look for supply orders in such base between two drops. And the other kind of zones are supply zones. Okay, we have them here on the top of our price Rayleigh. Okay, it rallied, then price met supply, some offers. These offers were strong enough to push price back down. So we rallied into it. Now we can mark it from here, so it would be easier to see. So we have basically rally, base, and drop. So it's another case, rally, base, drop, and we could mark here another zone, okay, selling zone, where we anticipate plenty of sell orders. Another example of rally, base, drop, okay, and price turnaround here in previous supply zone, so it's okay. But another test of this zone brings price to this resistance level. It's extreme point of our first supply zone here, but we don't have base. It was pretty rapid reaction. Take a look, pretty rapid. So another test with wick, and another attack of bulls of demand, and now we have fake breakout, fakey, it's called fakey, fake breakout of our resistance level. Another rapid reaction. We don't have base here. Probably on a lower time frame we would notice some consolidation, very small, but technically fakey is a rapid move above level and rapid withdraw, and we see decent price drop here. So playing with a trading with a it's sell stop. Trading with a tight stop loss would leave us with loss and no position here, only 33 pips. So it's pretty tight zone. Let's check. It would give 3-to-1 risk reward ratio if we wouldn't be stopped out. So it's pretty hard here. We would have hard time. And going back to this rally, base rally, we can also have it another way, like drop base rally. Okay, so if price would come down here, made a range consolidation base here on this supply level, on this demand level, sorry, and rallied up, we would call it drop base rally, and we would anticipate that strong demand is somewhere here inside this zone. If we check what price did later, we see that it dropped pretty hard near this large zone, large base filled with demand. But also we see that price dropped into this small demand zone. And now where the problem is, which zone is strong enough to reverse the price and which zone is not. Some traders try to measure duration of such range of sideways, of such base. Some are measuring width, okay, if it's wide, if it's narrow. Other traders think that if consolidation lasted for a short period of time, then it means that difference between supply and demand was very high, and they anticipate that there is plenty of orders in smaller zones. But the problem is, the thing is that if such consolidation if such base is small, it doesn't necessarily mean that that demand was strong. It may mean that supply was weak as well. So weak supply and bit stronger demand doesn't mean doesn't necessarily mean that demand is strong. Demand is stronger, okay, than supply, but it still depends how strong supply was. Here probably it wasn't too strong, but it was enough. It was enough to reverse the price. Here we see test of this zone, and it's very rapid reversal with very long wick. Actually it's pretty decent pin bar, and price moved up roughly 130 pips. Then it moved down a little bit and made a retest. So we've marked this zone with range. We used whole range, no, not any, you know, most traded level or close level or open price inside. We have here most traded level, okay? Here it would be like 108.12, and here we have 108.21, right? And our price reaction was, here it wasn't, it was 108.10, but here it was in point, right? 108.20, okay? So this level is legit for sure. And great demand arise, and took the price up all the way. Take a look, it was like 280 pips. Some traders wouldn't use this retest to buy, because some traders think that if demand or supply zone was tested in past, it will be too weak. It might be, it not necessarily it will, but it might be too weak to hold price and to move it again. Here we see that demand traders probably add some orders here to buy here on a retest, because it was the second test which took price significantly up. So here we see base after rally and before drop, so it's rally base drop, okay. Here we see some base. It's pretty problematic, because we have also wick here, down here, and such area should be probably extended, so it's rather big, and it's hardly a base now, so because of this wick, okay. And that's another problem about this supply demand zones, because supply demand is not only there, not only in bases, in such ranges, such consolidations. Here we have hardly any base, okay, and we see that there was decent supply, okay. It pushed price down quite a bit. So here we have, okay, here we have supply level. There are some offers, we see it because of this wedge, and we see it's some kind of compression here, okay. Here we don't have clear base, but clearly we have demand, very strong demand, okay, which price have shot up to the top side, but it's hard to find base here, okay. If we could try to mark this place, but to be conservative we need to take the whole range, whatever it is, okay. So it's pretty difficult to in many cases to determine how would our demand zone or supply zone look like, because chart is not always as clear as beautiful as examples might show us, okay. We see some supply, some demand here, decent supply, retracement, and here some green candles, some buy orders, okay, at the bottom of this area. So it's probably also a demand zone, okay. And when we look at formations, technical formations, they all try to find spot places where spot levels where supply and demand are imbalanced, but in different ways. So supply and demand levels are not enough, and are not the only source of supply and demand, of buyers and sellers. We see here some level, okay, another one, and it's technical support resistance level. It's not a, I don't know, classical supply demand zone, but it's apparently it's a level where demand is approaching and some supply is has appeared in past, I'm sorry, and we anticipate some demand might appear again here, okay. So such formation we have here, probably it's a head and shoulders pattern, very small, but it forced us to anticipate corrective move, okay. Okay, so price rallied, made some compression, some base, rallied again, made base, rallied down, made something like second shoulder, and went down, okay. So being long here and seeing such pattern here, I would have stop loss somewhere around here, anticipating corrective move, retracement, okay. So basically having head and shoulders neckline would be our supply demand zone, okay. And actually it wasn't a classical supply demand where we have base and you know the bottom side and the top side, but clearly there was some demand here, broken down, and then supply appeared. That's the issue. Trader need to look at demand and supply, very complex, not only one part of the picture, small picture where you are looking for bases, because also supply and demand is all over the chart, and red candles, green candles, upward candles, downward candles, or bars, or whatever you use, they have such shapes not by accident. It's not a lottery where will be high, low, open, close. It's determined by supply and demand balance or imbalance. Here we have wick and candle low here, okay, 0.839. Why is that? Because there were some buyers, okay, around here, about around this level, around this bottom, there were more buyers, they wind up price. Same here, there were sellers, they made candles high here, okay, not by accident. It's because there were sellers, no more buyers, they pushed down the price. Close was near the open, just because neither buyers or sellers could win during this time period. It's 1 hour, okay. And last thing I would like to mention is that supply and demand zones are not enough. That's not enough for effective trading, to earn money from trading. Why is that? Because supply and demand zones doesn't provide us any hints about direction of a market. I mean, overall tendency, like trend. Okay, if we have chart like that, okay, for example, we don't know which direction is prevailing. Okay, we see something like choppy sideways, and what we need to know is what is overall trend on this pair, because supply and demand zones, resistance and support levels tend to be broken. Some are broken, some are holding and reversing the price. So we need to determine somehow where the probability is, what the edge is. If we are in an uptrend, price will tend to break resistance levels, and supply zones would be significantly weaker. Why is that? It's because there are more buyers than sellers in general, and that's why this trend is existing. That's why we have rising trend, okay, upward trend. So we don't sell demand zones in uptrend, and we don't sell supply zones. Sorry, we don't sell supply zones in an uptrend, and we don't buy demand zones in a downtrend, because these levels tend to be broken. Okay, during an uptrend, resistance levels tend to be broken, because in general there are more buyers than sellers. That's why it's an uptrend. So that's all, traders. Check out Protrader 3 and have a good luck trading. Bye.